Panic, panic. The market has dropped dramatically toward the end of this last week, and we are in big trouble. Huge doo-doo. Okay. So today what I want to share with you is how to address this, how to look at this as a professional trader. And we're going to use one tool today called the VIX index. Many of you have probably heard of it. If you haven't, you need to know how to read this. And that's what I'm going to show you today. But I'm going to show you from a more professional level than an amateur level. So here we go. Going to give you some unique things you probably haven't seen anywhere else on how to read this. And this can change your trading forever. This will give you some of those amazing, huge trading opportunities you'll ever have. Seriously, when you get this right, there is so much money that can be made. We're talking about big, big, big trades. All right. So now what most people will do is they will tell you to look at levels. So numbers over here on the right. And they will have certain numbers in mind that they think are really high. So 30 is one that's commonly used. 20 is one that's commonly used. And I'm here to tell you that that's a fool's errand. These numbers statically do not mean anything. Everything in the market is relative unto its own history, unto itself. That's a general principle of trading. So there's the 200 simple moving average. Now, that's the first indicator we want to put on here. Now, when I say indicator, really, it's just mathematically showing us what has been the level of the VIX over the last 200 trading days. So remember, that's 200 trading days. So that's it. That's the average. That's the mean. That is normalcy. So whatever number some people might pick at random, saying it's 20, it's 30, it's whatever. No, the number actually in recent market history is 14.25. That's average. That's a balancing point. That's the line in the sand. Anything around that is meaningless. It's a neutral VIX, if you will. As you can see, a little bit below it means nothing. A little bit above it means nothing. A little bit below it means nothing. A lot above it, okay, now we see a real standout here. Now that is significant. That is an extreme. And in trading, again, another general principle of trading, you always want to look for extremes. You don't want to trade around the mean, around the normal range, because that's where noise is. Okay, noise signal ratio. Signals are these extreme levels. All right, so that was a great opportunity to go long. This is an inverse indicator. That's where there's a lot of fear, a lot of blood running in the streets, as we mentioned earlier. Then it comes back down and just kind of hovers around the 200. Anything around here is nothing. Now, kablambo, that's another professional trading term, by the way. Wow, big, huge spike. All right, and that's where we are now. So again, this is why this is a timely topic. It's very, very, very significant. So yes, now we have a dramatic move on the VIX, far away from the 200 SMA. Let me show you another tool that I use as well that's very, very helpful. What we have here are Bollinger Bands of the VIX. Now, what do Bollinger Bands measure? They measure the volatility of the underlying market that you plot them on. So what do we actually have here? We have, and get ready for it, I kind of like saying this, we have the volatility of volatility. Isn't that kind of cool? We have the volatility of volatility. So with Bollinger Bands, by plotting Bollinger Bands on the VIX, we are getting a really, really great indication, a very clear indication of when that volatility of the VIX, of volatility, is extreme. So let's bring up our drawing tools again. So we had looked at it looked at the VIX in relation to the 200 SMA. But now, okay, we're below it a little bit. But look at the Bollinger Bands, very tight together. Now, coming into this period of time, we had high volatility. But now, as the Bollinger Bands come close together, low volatility, low volatility, low volatility, a little better, not too much, but still nothing significant, right? We want it to be dramatic. Here's another general principle of trading. If you're wondering if something is dramatic enough, a big enough move, or the indicator's making enough of a change, then the answer is no. Okay, if that question comes into your self-talk of your mind, I wonder if this is enough, just default to no, because you want to default to saving money. You want it to be super clear. You want it to be so obvious that there's no doubt in your mind. And again, that applies to any indicator, price action, anything, even in your trades. Now we see, Blambo again, this time a nice Bollinger Band squeeze, wide range, right? Again, if you compare this to anything over here, this is dramatically bigger. That is very clear to the naked eye. And so now, we have high volatility of VIX. And then it comes on back down. There's a cycle between high volatility and low volatility, by the way. Very important to know that. So we go from a low volatility. Let me get these off of here so that, because I got a lot of drawings on here. So here is a period of time or a cycle of low volatility. Then we get a period of time of high volatility. Then it reverts back to a period of time of low volatility. And right now, at this very moment, we've gone into a period of high volatility, a cycle of high volatility. And what's interesting about this too is, look, this bar, for example, it spikes all the way down here, hits the lower Bollinger Band, goes up, and it actually, again, this breaks above the upper Bollinger Band. The upper Bollinger Band is here. This one broke above the upper Bollinger Band too. But now this one did too over here, but again, the Bollinger Bands are still tight together. So very clear that it's not just about price getting above or below the Bollinger Bands. It's got to spread those indicators out, spread those bands out from the top to the bottom in a very clear, dramatic fashion. Now we have a high volatility market and we have fear. We have blood running in the streets. One last thing about this. The VIX is a broad stroke, they call them a breadth indicator. So you can't pinpoint an entry on the VIX, just like with a lot of other breadth indicators. You can't pinpoint an entry. So the timing is exactly when to enter. In this case, we'd be looking to get in on a low. We'd be looking to buy. But the time is not right now. So we need another indicator, which is a precision indicator, more of a scalpel tool in our toolbox. And I've got that for you. It's my market timing indicator or my cycle indicator. I give it to all my viewers for free. Just go to indicatorwebinar.com. I'll show you how to set it up on your charts. And I put it into a little recorded webinar so that you get the tutorial. Just like now, I'm teaching you how to read this. When I give you that indicator, I teach you how to read that indicator as well so that you become a self-empowered trader.